August 8th, 167.5. No. Oh, sorry. Hey, good morning, everybody. How are you doing? We're going to talk Tesla and Google earnings today. Google. Also, we're going to talk a little bit about earnings pricing. We're also going to see how Tesla and Google are pricing things right now. Relative to past earnings. And I got to close my door because my dog is barking. Yep, totally. Pearl, enough. You crazy dog, shush. I know. You know what? She's barking at somebody is going by in a boat, and she's yelling at the boat, barking at the boat. Steve is asking, any thoughts on Powell's comments? What did he say? Well, let's take a look. VIX is up 63 cents and SPX is down 0.29. So all I can say is the market kind of doesn't like them. So I have to look and see what he says first. If somebody wants to put it in the chat, I haven't seen. I thought he had he talked at 8:30, but I don't, I think most of what's going on with the market right now is Trump keeps threatening to fire him, do this or that. Powell's not, lowering rates. And this is what we have. For all of you that, if you read any of my F market blogs and things like that, we are in this sort of perpetual trade war, interest rate. It's like these things just keep hanging around and they don't go away. But all the market cares about is basically AI. And also for those of you that are RIP Zone students, Mark had an NVIDIA strangle on. I put out a close on the August 8 puts. I think they're trading around $6. So you might want to hit the bricks on those August 08 167.5 puts. I think that brings us the strangle for a fairly good price now. We got 80% on the puts. So I wouldn't dilly-dally too long with it. But let's go to the general earnings stuff. So basically, everything is going to be about tech and tech earnings and tech around AI. I know Hans has been talking about it for a couple of weeks, and that's pretty much his theme for the next 6 months to 5 years. But we do have a couple of big tech stocks here and how things are pricing. Now, what I want to say is Google is very interesting. Oh, Jerry's saying Powell's lawyers are crying that he not change his rate directions due to the recent referral for criminal investigation for perjury. Very, very funny. So basically, if Congress just lowered spending, wouldn't interest rates go down? Nobody wants to do what they're supposed to do. Just an observation. All right, so let's go into Google. So the first thing is about earnings in general is kind of what happens, right? And let me get you some notes here. So let's just talk about earnings in general. And basically, earnings pricing. So what I want to do here is how this works in general is traders pick a straddle price. They pick a price they think that will cover the earnings move. So if you're new, right? If you're new in here, this idea cover, right? And how do they know this? Okay, well, I was a market maker for 15 years. How did I know what the earnings are going to be? How did I price the earnings? And basically, what we did is we guessed, and then all of a sudden, the market would tell us how good our guess was. So we didn't have weeklies back then. We only had weeklies once a week during expiration. We only had dailies 1 day a month. Right? So now I'm dating myself. Andrew, you're a market maker before weeklies. But how do you trade them? You didn't have them. We had them. We just had them 1 week a month. And we had dailies 1 day a month. Very exciting. There's so much more to trade now. It's ridiculous. So much more opportunity. So, however, what you do have now you almost always on a big stock have the 1 week move priced for you right away. So the liquidity provider basically says the range for Google is going to be around $20. The straddle is 10, the range is double. So that means Google down to 177 as high as 197. So right now, their market is giving you a range. And that range is right here. That's the best guess, is right there. Right around a little more than 10 bucks, around 11, so $22. Right? And this $22 is what I would call the cover move, right? So the range is the call, right? The call and the put doubled. At the money, doubled. Now, they're not really giving you with the range in Google, right? They're not giving you a direction at the money. Now, I personally think 10 bucks feels a little cheap. I don't know about you, but when I'm looking at an earnings play, if I want to, and I don't mind them every once in a while if the options are cheap enough. Right? So right now, if you're looking at Google, so 76 volatility is the price they're charging you for Google right now. So basically you have 2 days of action, 2 to 3 days of action. However, and the price of this is, we're going to call it $11. But you can go out to August and the price is only $3 more. It's actually $4 more. It's 15 bucks. So the August pricing is $15. Now, if I'm looking at this as a play, I'm like, put spread is not that expensive in here. 85.75 put spread is $3, and you could buy, let's say, a 200 call for $365. It doesn't look that expensive to me. And the second thing is, what did the stock do just into earnings, right? So basically 2 weeks ago, we were trading 174. We're already up $14 from there. So if I go 2 weeks ago, what were they pricing the at the money straddle going into earnings 2 weeks ago? So what I'm just trying to show you is how the price of these things evolve. So the July, so if I'm looking at, let's call it the 9th. Okay, the July 25, let's call it the 175. So do you guys see the price of that 2 weeks ago? The July 25, 175 straddle. Do you guys see the price of that there? It was priced at what? It was priced at $10.60. What's the at the money price right now? It's the same. So, students, if you want to trade earnings, how much dollar risk do you feel you're putting out if you actually buy a straddle 2 weeks or buy options 2 weeks prior to the earnings in some of these big name stocks? Can you believe you could buy options and they didn't decay at all? Robin's telling me the Google IV at 612 was 27.8 and now is 39.53. Totally got that. But what I'm showing you is, can everybody sit here and tell me that those options, the at the money straddle, hasn't moved in 2 weeks? Don't you find that interesting and odd? Where's the decay? Where did it all go? We just went 2 weeks, and now the new at the money straddle is the same price as the old one. Anybody find that a little odd, a little different, a little wacky? Neil, a little wacky for sure. So what I'm trying to give you is, Sniper Baker is asking, are you saying that the theta decay is arrested by the vol increase? Yes. So part of trading options, right, is having a little understanding about how they're going to perform after you buy them. Now I'm starting to get more questions about other stocks, other Mag 7 stocks. James H is saying the IV is much higher now though. And that is 100% correct, right? What has changed between July 9th and today? What's the thing that's changed the most, right? The stock price has gone up, but what else has happened? We're that much closer to the July 25th expiration. We only got 3 days to go. So Robin is saying a 45% increase in vol for Google heading into earnings. Is that normal? And I would say, does anything about this pricing, the straddle being $10 right now, right? Does that feel normal, or you're trying to get a sense of it? But to me, this seems pretty normal. Right? Basically how this runs. Now, if we look at in the right, because if we look at here, the earnings analysis, basically your average move in Google is around 6.5%. That's the average actual move, either up or down. So what's going on is 6.5% right now on a $190 stock. 10% would be $19. So we're looking for about $8 or $9 on a 1 day move. So a question I'm getting, is it typical for tech stocks to have vol expansion approaching earnings? So my question to you is, how can a stock not have vol expansion into earnings if you pick the straddle price at the beginning? Do you guys remember when I told you this? Traders pick a price that they think will cover the earnings move. So 2 weeks ago, what did traders think the earnings move was going to be on July 9th? Right? What was this price? Around $10. Then Google moved, right? Google moved $14 in those 2 weeks, straight up. So traders expanded the straddle a little bit. Personally, I think it's a little low. So if I'm looking at this, I would not be a seller of these options for Google. So it's something we're going to look at in Ripzone today at 11 o'clock. Could be an interesting trade in there. So what I want you to see is, is it possible to have an earnings trade? Is it possible to have an earnings trade even though you're not trading the earnings, but you could put it on 2 weeks before and ride whatever is happening into earnings? Is that a potential trade you could make that you never thought of before? There's 200 people in here. Do you think that's a potential trade that you could make, or you could think about, oh, I like this stock? I think it's going up. I could buy some cheap strangles. I could buy a call and a cheap put, and I can ride it into earnings and see what happens. The market does something goofy, you have the put. So what I'm trying to tell you is, but you have to be a little selective with the stocks that you pick. And the reason why is I personally like bigger, higher market cap names because they tend to underprice the volatility relatively early because they keep the straddle relatively big. But you can still get, if the market moves, you get a lift in the stock, you get a little action beforehand. It's like a free ride. So again, setting up trades, part of setting up trades is how long can you get a low risk free ride for? And then Sniper's asking, how would market makers react if Google went down 14 instead of up 14? I think from that price, the vol would probably be a little higher, Sniper. Instead of where it is, maybe, at least at the money here, about 6 or 7 vol points higher. Al Omega says, yes, it is a potential as long as its price doesn't remain in a narrow range, which would decay our options. But what I'm trying to explain to you is, did the options actually decay? Right? They might decay a little. So again, those are the risks that you take with any trade, but you're not getting a lot of decay. Again, if you put on a trade and you have, the risk of your trade is only 5% of, let's say, your premium dollars for a 2-week time, you basically have a very small penalty for a very long hold time. Does everybody understand that? When you buy a call, you're kind of risking all your premium when you buy the call, aren't you? Like, because if the stock just goes down, Alamega is saying within a narrow range, it would. Only time will determine what actually happens. So you're missing the point that options are not decaying normally going into earnings, which is the point of this. They're decaying much less than normal. So is this a technique you could use all the time, no matter what, going into earnings? No, but this is generally how it works. So if options are cheap enough, right, for a 2 to 3 week hold time, you could have an interesting trade. Right? And by the way, anytime you buy an option or anytime you sell an option, do you have any control? Right? Do you have any control as soon as you put that position on? Do you have any control about what's going to happen? No. You think you might, but you don't. You got, as soon as that position is open, you're out of control. The only thing you have is how you manage your risk, allocation, all the rest of it. We're not going to cover that today. Today is just showing you, right, illustrating how options work, right? And this is a good example. Google's tonight, how options perform into earnings. Right? And this is how I remember them performing when I was a market maker. Nothing has changed. The only thing that's changed now is so much more volume, right? So much more volume. So me personally, I don't do any recommendations about anything in state of the market, right? Education and observation. Carrie's asking, I'm just curious, what is the rationale of doubling the at-the-money straddle for the range? Because that's where your break even is, Carrie. If you double the straddle value, that's your break even. If you think about it. So if I'm a market maker and I sell that straddle, I know that I'm good within that range. Right? You sell a straddle and you're 25 cents in the range, you don't care. You're not losing any money. Hopefully that answers your question. All right, let's look at Tesla. Let's see what's happening with Tesla. Because Tesla's been moving around a bit. Do you find this interesting? Hopefully, maybe not. So again, I've been trading options for 36 years. And the first 17 as a market maker. So understanding how options work is a big help, because the market, you don't know really what the market's going to do ultimately, but you can understand how your option's going to perform over a period of time, given a sort of set of circumstances, meaning earnings are coming out, the Fed's going to say something, right? I'm buying a straddle, I'm selling a straddle, I know what decay should be, I know what happens if volatility explodes. These are all things it's very important for you to learn and understand. And WA is asking, when stocks rise into earnings, doesn't that raise the risk of a bigger pullback after earnings? Maybe. Tell that to NVIDIA. Okay, let's take a look at Tesla. Now, 2 weeks ago, so right now, Tesla's trading 327. The July 25, let's call it the July 27 straddle, it's $24. All right, we got 24 bucks. Let's see let's have a couple of examples so we get an idea how things work. Okay. Let's take a look a couple weeks ago. So we're looking at the 300 strangle for July 25, 2 weeks ago, or the 295. So the 295 straddle 2 weeks ago was, I'm going to call it 29, almost 30 bucks. Right, I'm going to say that's, I think, fair, about $30. Now, volatility here was trading around 61. And right now we're trading 24. So this straddle just dropped $6. $6 from then. Now it's only going to expire in 3 days, but the value of the at-the-money straddle has dropped $3, even though we have moved at least 30 already since that point. So Tesla volatility was probably starting at a bit higher of a level going into this. So you lost, the at-the-money straddle still lost around $6, it looks like, from what I can tell. Now you still would have you still would have made money buying, just straight buying the straddle, but it's definitely, again, $24. It doesn't feel that high. Doesn't feel that high. It certainly wasn't as good a trade as Google was. And Google was much more of an opportunity, I believe, because the implied volatility was cheaper beforehand. Tesla was already, if you guys recall, over the last couple of weeks, remember Trump, I love Trump. Musk and Trump, they're in love, then they weren't in love, then they're out of love again, right? All that kind of stuff. So Tesla had a much higher volatility to start with. Yeah, so Tesla has a higher vol. Is it, in my view, it's not as good of a trade as, Google is, because Google, the option prices were relatively low. So again, what I would say here going into earnings, this is a technique you could use, right? What I like generally about 3 weeks prior to earnings. Take a look. That tends to be the sweet spot. Just from observation, 3 weeks prior to earnings, take a look and see how it's priced, right? Because you're going to have you're going to have a much lower decay profile than normal. Does everybody get that? Different stocks. Again, I would stay in probably the top 50 tech and look for cheap options. Look for cheaper options. Now, there's a lot of trading here. There's a lot of trading in here. Where are we getting access to option prices 3 weeks ago? LiveVol, Al Omega. You could purchase LiveVol through Option Pit. You could look back at Thinkorswim. Again, I'm giving you a technique that I use that is interesting to me and to explain to you how options work going into earnings. And that is all for today. We are done. If you want more, check out some of our services at Option Pit. I teach like this every single day. 250 trading days a year. Okie dokie. Again, these will all be topics we'll cover in class this week. Hopefully you learned something. If you didn't learn anything and said you knew all this ahead of time, write it in the chat. Say, Andrew, this is all crap. I knew this before I came to class. But if it's new and you like looking at options like this, join us at Option Pit. You guys have an excellent day. Take care.